The economy is at a boiling point. Markets are hitting new highs, confidence is soaring, and investors everywhere are celebrating record gains. But amidst all this optimism, one man is sounding a loud and urgent alarm. Michael Burry, the man who correctly predicted the 2008 financial collapse, is now warning us that what's coming could be even worse than a recession. A lot of people are riding the wave of optimism, but is it all just an illusion? What's really happening behind the scenes, and how can you prepare for what's coming? Stay tuned, because by the end of this video, you'll understand why Burry's warning might be the wake-up call you need to rethink your entire investment strategy. In today's video, we're diving deep into Michael Burry's latest moves in the market and the ominous predictions he's making for the U.S. economy. With the stock market breaking records and people thinking the good times will never end, Burry has done something surprising. He's pulling out of U.S. stocks and betting big on China. That's right, he's putting his money in markets many investors are avoiding. But why? Is he just taking a risk, or does he know something the rest of us don't? And, most importantly, what does this mean for you as an investor? In the next few minutes, we'll break down why Burry thinks the U.S. economy is on the brink of disaster, why he's doubling down on Chinese stocks, and what you can do to protect and even grow your wealth in this uncertain time. Buckle up, because this isn't just about numbers, it's about understanding the psychology behind the markets, the data that's being ignored, and why now is the time to question everything you thought you knew about investing. Let's dive in. This isn't just another market prediction, it's a warning from someone who saw the global financial crisis coming in 2008, and if you ignore it this time, it could cost you everything. You won't want to miss the critical advice we're about to share. Imagine being part of the 2008 crash, watching your portfolio wipe out 50% or more, simply because you didn't see the warning signs. That's the reality many are facing now, and Burry's telling us it's going to be worse. This video isn't just for seasoned investors. If you've never paid attention to market shifts before, now's the time to start. We're going to break down Burry's strategy in a way anyone can understand. Why China? Why is Burry, of all people, turning to Chinese tech stocks when the world seems to be turning against them? The answer may surprise you, and it could change the way you think about global markets. When you look at Michael Burry's recent portfolio filings, there's a clear pattern emerging. He's pulling away from US-based assets, and that's a big deal. In fact, his latest moves have sent shockwaves through the investment world. Why? Because Burry is a man who doesn't follow the crowd. He's the type of investor who makes decisions based on data and fundamentals, not trends or emotions. For example, Burry has completely exited his positions in Hudson Pacific Properties and BioAlta. That's over 1.7 million shares sold, a decisive move that signals his loss of faith in the resilience of U.S. markets. These aren't just random stocks he's dumping, these are key U.S.-based assets that many people would still consider safe bets in the market. But not Burry. He's cutting ties with them. And if you've been following the markets lately, you know that's a massive red flag. When a seasoned investor with his track record begins walking away from U.S. assets, it's time to listen. But here's the thing, Burry's move is not just about him pulling out. It's about what he's choosing not to invest in. As the U.S. stock market keeps hitting new highs, there's a psychological game at play here. A lot of investors are clinging to the idea that these highs will continue. The media keeps feeding us headlines that things are only going to get better, and so many people get stuck in this cycle of chasing the next big win. But what if I told you that Burry sees a disaster looming on the horizon? Not just another recession, but something much worse. His move to pull out of U.S. assets is a powerful signal for investors, especially those with a long-term view. Could you be on the wrong side of history, like the people who ignored the warning signs before 2008? Now, here's where things get even more interesting. While most investors are running away from China, Burry is doing the opposite. He's doubling down. In fact, he's making huge bets on Chinese companies like JD.com, Buo, and Alibaba, signaling his belief in their recovery potential. These aren't just small plays either. We're talking about a massive shift in his portfolio toward Chinese tech stocks. And if anyone knows what he's doing, it's Burry. Take JD.com, for example. Burry recently doubled his stake in this Chinese e-commerce giant, making it a massive 24% of his entire portfolio. Let that sink in for a second, 24%. That's not a small position, especially in a market like China where many investors are still wary of government crackdowns, regulatory uncertainty, and geopolitical tensions. Yet, Burry sees something others don't. His move is a bold, calculated bet on the future of Chinese tech, even as the majority of Western investors remain hesitant to touch it. But why JD.com? Why is Burry all in on this company? Well, JD.com has been rapidly expanding its logistics network, has one of the largest user bases in China, and has been diversifying into tech and AI. Burry sees this company's massive growth potential, even when others are worried about the volatility of the Chinese market. Many investors are often swayed by social proof. They see everyone around them jumping into U.S. tech stocks like Apple, Tesla, and Amazon because that's what the mainstream media tells them to do. This creates a confirmation bias. Investors are only looking for signs that support decision to stay in the U.S. markets. Burry, on the other hand, is going against the herd. He's seeing opportunities where others are seeing risk. This is the psychology of contrarian investing, the ability to see the cracks in the system and take advantage of what others overlook. We've seen this play out before Burry did it during the 2008 financial crisis. While everyone was hyped about the housing market, Burry was quietly betting against it, armed with data and insights the rest of the world ignored. And we all know how that turned out. Burry's investment in JD.com and Alibaba isn't just about picking undervalued stocks. It's about looking beyond the fear, beyond the headlines, and seeing a real opportunity in the long-term potential of Chinese companies. He's not falling for the short-term noise. Instead, he's focused on the data, the same way he predicted the 2008 crash. Michael Burry's moves are a reflection of his contrarian genius. This man doesn't follow trends. He doesn't chase the hype. When most investors are dumping Chinese stocks due to political tensions or regulatory crackdowns, Burry is stepping in, seeing them for what they really are, undervalued gems that could explode in value once the market begins to calm down. And the fact that he's making these moves now is no accident. He's positioning himself for what could be the next big thing, China's economic recovery. Burry sees something that many of us can't. The Chinese government is rolling out massive stimulus plans, with more than $1.8 trillion being allocated for infrastructure and tech investments to stabilize the economy. For investors willing to ride out the short-term volatility, this presents a compelling opportunity. But it's not just about the stimulus, it's about the potential for long-term growth. While U.S. markets might be reaching unsustainable heights, Burry is betting on China's recovery, which could be just around the corner. And this is where Burry's psychology comes into play. He's not swayed by the mainstream narrative. He's looking at the data and making moves that make sense for the future, not based on speculation or short-term gains, but on what will provide real value down the road. Let's face it, the U.S. stock market has been on a relentless upward climb, and for many, that feels like a sign of strength. But for Michael Burry, this isn't a sign of prosperity, it's a warning sign flashing red. One of the key indicators he's tracking is what's known as the Buffett indicator. For those of you who might not be familiar with it, this indicator compares the total value of the U.S. stock market to the GDP, essentially telling us whether the market is overvalued relative to the economy. Right now, the Buffett indicator is sitting at an alarming 208%. That's an all-time high, and it's significantly higher than the 140% peak during the dot-com bubble or the 110% before the 2008 crash. What does this mean? It means that the market is way more expensive than it should be based on the economic output of the country. In other words, the stock prices are detached from reality. Now, if you're an investor, this should raise a red flag. The market might look strong on the surface, but when you dig into the fundamentals, things start to get wobbly. This is the kind of setup that precedes major corrections. The market is essentially a house of cards, and the higher it gets, the harder it will fall. Here's where it gets interesting. Many investors are experiencing what psychologists call loss aversion. It's this fear of missing out on potential gains that can cloud your judgment. You see, the market keeps climbing, and the headlines are filled with record highs and bull runs. It's easy to get caught up in the euphoria. No one wants to be the person who pulled out too early, especially when everyone else is making money. But here's the thing. While people are chasing these gains, the reality is that the market is overinflated, and it's only a matter of time before the bubble bursts. This is where Burry's contrarian mindset kicks in. He's betting on the idea that investors are so wrapped up in the excitement that they're ignoring the fundamental risks. And believe me, ignoring those risks can lead to massive losses when the market corrects. Think back to 2008. People thought the housing market could never crash, until it did. But Burry's concerns don't end with the overvalued market. He's also deeply worried about the skyrocketing U.S. national debt. The numbers are eye-popping. U.S. debt has surged to 123% of GDP. To put that into perspective, it was just 33% back in 2008. The national debt has now crossed over $36 trillion, and servicing this debt is becoming more and more difficult for the government. How does this affect you as an investor? Well, it impacts everything, from interest rates to inflation to the broader economic stability. When a country's debt is this high, it's forced to take on more debt just to keep up with interest payments. Eventually, the government may need to raise taxes or cut public spending, which could trigger economic slowdowns. In the worst-case scenario, the U.S. could face a debt crisis, something that would send shockwaves through global markets. Burry's prediction is that the U.S. is approaching a tipping point. As debt continues to rise, there's a real possibility of a financial reckoning. And it's not just the government that will feel the pain. American businesses are also carrying enormous levels of debt. In fact, many companies have been relying on cheap debt to fuel their expansion. But as interest rates rise, the cost of servicing that debt becomes unsustainable. It's easy to think that the U.S. can keep borrowing indefinitely, especially when we've seen periods of growth even as debt piled up. This is an example of anchoring. Investors are relying on past experiences, thinking that since the U.S. has always been able to service its debt, it will continue to do so. But that's a dangerous mindset. The rules of the game are changing, and debt is becoming harder to manage. The availability heuristic is at play here too. Because we've always been told that the U.S. is too big to fail, we tend to assume that nothing will ever go wrong. But the truth is, nothing lasts forever, especially when it comes to national debt. And if the national debt wasn't enough to worry about, there's another looming threat: rising interest rates. For years, we've had a period of historically low interest rates. This allowed companies to borrow cheaply, refinance debt easily, and fuel growth without worrying about the cost of capital. But now, interest rates are surging, and that's making it harder for businesses to borrow money. For example, companies that once relied on cheap debt to grow are now facing much higher costs to refinance. If they can't manage these higher costs, they could be forced to cut back on investments, lay off workers, or even go bankrupt. It's a ripple effect that could send shockwaves through the economy, triggering a major downturn. Burry believes this is pushing the U.S. markets into bubble territory, and that a major correction is on the horizon. In fact, he's predicting that the market could crash under the weight of these rising rates.
Why?
Because much of the market's current growth has been fueled by cheap credit. As that credit tightens, many companies will find themselves on shaky ground. This could lead to widespread defaults, a loss of consumer confidence, and ultimately, a major correction in the markets. Many investors, however, are under the influence of recency bias. This is the tendency to give too much weight to the most recent experiences or events, assuming that trends will continue based on what we've just seen. Right now, the stock market has been on a bullish run, and that's leading investors to believe that this will continue indefinitely. But Burry's warnings suggest that these trends might not be sustainable, and we could be headed for a reality check. The pain of a market correction might be coming sooner than many think. So, in summary, Michael Burry sees a perfect storm brewing in the U.S. economy. Overvalued stocks, an unsustainable national debt, and rising interest rates are setting the stage for a major market correction. Burry has always been one to trust the data, and right now, the data is pointing to a future where the U.S. economy faces a reckoning. As an investor, it's crucial to consider these warning signs and think about how they could affect your portfolio. Burry's shift away from U.S. assets and his bet on China might seem counterintuitive to some, but in his view, the U.S. market is on the verge of a major collapse. It's a sobering thought, but one that might help you rethink your investment strategy moving forward. Let's talk about something that's been impossible to ignore over the past year: the surge in high-risk, speculative assets. Whether it's meme stocks or cryptocurrencies, there's been a huge rush of retail investors throwing money into markets with no solid foundation.
Why?
Because the fear of missing out, FOMO, is driving people to gamble on assets with sky-high valuations and little regard for the risks. Take Tesla, for instance. Despite being a household name and a leader in the electric vehicle industry, Tesla's P/E ratio is sitting at 12.74. Now, this might sound like a technical number, but let me break it down for you. This ratio is far higher than what you'd typically expect from a company with the fundamentals of Tesla. It shows that investors are pricing the company based on future potential rather than current earnings. It's speculative behavior in its purest form. The crazy part: even when there's clear evidence that the market is overinflated, investors continue to pour money into these types of assets.
Why?
Because they're riding the wave, hoping to catch a bigger return before the crash comes. They ignore the risks because they're blinded by short-term gains. The same pattern happened during the dot-com bubble, and we all know how that ended. This isn't just about numbers or market behavior. It's deeply psychological. Investors get caught up in what's called herd mentality. Everyone is doing it, so you feel like you have to do it too. When everyone around you is making money in Tesla or Dogecoin, the fear of being left behind is powerful. This leads to a cycle where people overestimate their ability to pick the right stock and assume the market will keep rising forever. This is called overconfidence bias. The thing is, these speculative bubbles are not built on solid foundations. They're fueled by hype, social media, and the fear of missing out on the next big thing. And while it might seem exciting to ride the wave, remember that these bubbles always burst eventually. The people left holding the bag are the ones who waited too long and got caught at the peak. But it's not just the retail investors who are in trouble here. Corporations are facing their own set of risks. With rising interest rates, companies that have been heavily reliant on cheap credit to fuel growth are now in serious financial trouble. Many of these businesses have taken on massive debt in order to expand, but as borrowing costs rise, refinancing the debt becomes far more expensive. If companies can't manage these higher interest payments, they may have to make difficult choices: cut jobs, reduce investment, or, worst-case scenario, file for bankruptcy. It's a domino effect that could send shockwaves through the entire economy. And the issue is even worse for those corporations that were already in precarious financial positions, operating with razor-thin margins or huge debt loads. The risk is clear: as interest rates climb, corporate bankruptcies could rise, and this would compound the economic instability that we're already seeing. Higher borrowing costs won't just slow down growth, they could send weaker companies over the edge. Now, let's talk about something else that keeps people invested in these risky behaviors: optimism bias. Many investors and business leaders believe that their company or investment will be the one to defy the odds. They think they have control over a situation that, in reality, is largely outside their control. This is called the illusion of control. The truth is, no one can control what happens when the market turns or interest rates rise dramatically. These are macroeconomic forces, and businesses that have over-leveraged themselves are at the mercy of these factors. But this bias leads many to believe they can weather the storm or that the good times will continue indefinitely. And this is why corporate risks are often downplayed until it's too late. Investors and executives alike are blinded by their own optimism. While many investors are hyper-focused on the risks in the U.S., Michael Burry is looking eastward, betting on the potential of Chinese companies like JD.com and Alibaba. But what makes China such an attractive option right now? First off, there's the simple fact that many Chinese companies are currently undervalued. Take JD.com, for example. This e-commerce giant has a P/E ratio of just 11, which is a fraction of what you'd find in similar companies in the U.S. market. For comparison, Amazon, one of the most valuable tech companies in the world, has a P/E ratio of 49.5. That's almost 5 times higher than JD.com. Now, you don't have to be an investment guru to see that JD.com is priced much more conservatively compared to its U.S. counterparts. Alibaba, another massive player in the Chinese market, is in a similar position with a P/E ratio of 17.68, again, much lower than the high-flying U.S. tech stocks. This presents a huge opportunity for investors willing to look beyond the noise and recognize that these companies may be significantly undervalued relative to their potential. Burry is betting that these stocks have room to run once the broader market stabilizes and investor sentiment shifts. But here's the interesting psychological angle. When markets are volatile, many investors stick to what they know, and that's typically the U.S. market. This is what's known as loss aversion. People are more afraid of losing money in unfamiliar markets than they are excited about the potential for big gains. It's human nature to avoid risks, especially when there's negative sentiment surrounding a region or sector. But Burry's contrarian thinking is what sets him apart. He's not afraid to look at the situation through a different lens. While everyone's looking at China and seeing economic slowdown, Burry sees opportunity. He's betting that the fear surrounding China is overblown and that long-term growth prospects, especially for tech companies, are still very much alive. His willingness to embrace a market that others are fleeing from could pay off when China's growth picks back up. On top of the undervalued companies, Burry is also looking at China's government policies, which could act as a tailwind for economic recovery. China has recently rolled out a $1.8 trillion infrastructure and tech investment plan to stabilize its economy and fuel future growth. Think about that, a $1.8 trillion investment to stimulate key sectors like infrastructure and technology. These kinds of initiatives create opportunities for savvy investors who are willing to look past the negative headlines. While many Western investors are writing off China due to concerns over its regulatory environment or recent economic slowdowns, the Chinese government is taking aggressive steps to counter those issues. By investing in the right companies now, Burry is positioning himself for the potential upside when this stimulus package starts to work its magic. In other words, he sees what others might be missing. China's government-backed efforts to spark growth and turn things around could be the catalyst that shifts the tide, especially for tech companies that are poised to benefit from this massive investment. What's fascinating is that Burry's strategy is an example of something we often see in investing, the fear of missing out, but in reverse. Right now, FOMO is driving many investors to pile into the US markets, where the sentiment is bullish, and the mainstream media is fueling a sense of optimism. But Burry is turning the tables. While everyone is rushing into what feels like a safe bet, the US, he's betting on China, where the opportunities are less obvious but potentially more rewarding. In many ways, this is an anti-FOMO move. He's betting on China precisely because most investors are too afraid to take the leap. While Michael Burry's bet on China may seem promising, it's crucial to understand that investing in this market is not without its risks. In fact, China comes with a set of challenges that can be daunting, even for seasoned investors. One of the primary risks is regulatory uncertainty. Over the past few years, the Chinese government has implemented heavy-handed crackdowns in various sectors, especially the technology and education industries. Companies like Alibaba, Tencent, and others have seen billions of dollars wiped off their market value almost overnight as a result of these regulatory moves. For instance, the Chinese government's crackdown on Ant Group, Alibaba's financial arm, delayed its initial public offering and shook investor confidence in the sector. Furthermore, investors in China face significant geopolitical risks. Trade disputes, particularly between China and the US, could escalate and affect market stability. And don't forget about the ever-present issue of currency fluctuations. If the value of the yuan depreciates, it could diminish returns for international investors, especially those in the West. All of these factors make investing in China more complicated and volatile compared to the US market, which has more predictable regulatory structures and stable currency fluctuations. But here's the psychological angle. Many investors are naturally risk-averse, especially in uncertain environments like China. It's easy to stick with what you know. The US market feels like the safe option. In fact, fear of loss and the desire for stability keep many investors from considering international opportunities. Yet, this fear of uncertainty can also lead to missed opportunities. Burry's ability to look beyond the noise, ignore the headlines, and focus on long-term potential is a perfect example of what's called a contrarian advantage. He's betting that the massive risks, like regulatory crackdowns and geopolitical tensions, are temporary hurdles, and the long-term upside for undervalued stocks will far outweigh the short-term volatility. For someone like Burry, who has seen the US market bubble up to unsustainable levels, the risk in China, while real, is manageable compared to the overhyped US market. Now, let's talk about the potential rewards. Despite these risks, there's a compelling argument for why Burry is doubling down on China's market. If you zoom out and look at the bigger picture, China is still the world's second-largest economy, with more than 1.4 billion people and an expanding middle class. This gives companies like JD.com and Alibaba a vast consumer base, which is a massive growth engine. Burry sees the potential for these companies to rebound in the long term. The Chinese government is actively supporting economic recovery with stimulus measures, infrastructure investments, and a focus on technology and innovation. As the Chinese economy stabilizes and recovers from recent setbacks, these undervalued stocks could see significant gains. JD.com's e-commerce growth, combined with its logistics network, positions it well to capitalize on China's growing demand for consumer goods. Alibaba, with its cloud computing division and dominant presence in retail, is also poised to benefit from the expanding tech sector. These companies are not just undervalued on the market, they are market leaders that could see substantial growth once the regulatory environment normalizes. So why does Burry believe that the rewards outweigh the risks? It's all about long-term thinking. While the short-term volatility in China might scare off most investors, those willing to stick it out and look beyond the immediate turbulence could see substantial rewards. This kind of thinking taps into the psychological principle of delayed gratification. Investors who are willing to endure short-term discomfort for the promise of long-term gains often end up with the greatest returns. It's not about quick wins, it's about positioning yourself for sustained growth once the dust settles. While there are definitely risks involved in investing in China, Burry's conviction lies in the fact that the long-term rewards could significantly outweigh those risks. For investors who are able to stomach volatility and look past the immediate challenges, opportunities like JD.com and Alibaba could lead to outsized returns. As with all investments, it's about balancing risk with reward, and Burry is betting that China's economy, despite its hurdles, is still ripe with potential. So, what does all this mean for you as an investor? Well, Michael Burry's recent moves can provide valuable lessons. First off, his decision to exit the U.S. market is a strong signal that things might be overheating. The U.S. market is currently overvalued, and Burry believes a correction could be right around the corner. If you're heavily invested in U.S. assets, this might be the moment to reconsider your exposure. Secondly, Burry's focus on undervalued opportunities, particularly in international markets like China, suggests a shift in how investors should be thinking. The growth potential in markets like China is significant, but the prices are much lower compared to U.S. tech giants like Amazon or Tesla. This could present a unique opportunity for those willing to take a risk. And here's the third takeaway: diversification. If your portfolio is currently concentrated in U.S. stocks, now may be the time to broaden your horizons. A diversified portfolio, with exposure to both U.S. and international markets, can help protect you from any major market downturns that could be looming. Burry is looking at international markets for growth, and this is a strategy that's worth considering. As investors, it's easy to get caught up in FOMO, fear of missing out, especially when the market is booming. But Burry's moves show that sometimes, stepping away from the crowd and reassessing your strategy can be the best decision you make. It takes discipline to resist the urge to follow market trends blindly, especially when others are diving into high-risk assets like meme stocks or cryptocurrencies. If Burry and Buffett can hold cash and wait for the right moment, so can you. Patience and discipline are two key traits that every successful investor needs. When the market is this volatile and overvalued, sitting on cash might seem frustrating. But both Burry and Buffett have used this strategy to wait for more favorable conditions. They know that in times of excess, it's better to wait for opportunities rather than chase the latest hype. If you're in a similar position, holding cash and biding your time could be a prudent choice right now. At the end of the day, Burry's warning is a call to action for all investors. It's time to rethink your strategy. Don't follow the crowd. Make decisions based on data and long-term value rather than short-term noise. The market is always changing, and those who react impulsively often pay the price. Burry's years of experience and data analysis suggest that the next phase of the market could be much more challenging, so now is the time to prepare for the storm, rather than get caught in it. This isn't just about avoiding loss, it's about taking control of your financial future. While others are blinded by optimism or fear, now is the time to think like a contrarian. It might be uncomfortable to question the trends, especially when everyone around you is excited about rising stock prices, but in the long run, this approach can offer substantial rewards. Control your portfolio, manage risk wisely, and be ready for what's next. If you found this video helpful, don't forget to hit that like button, subscribe for more insights, and share it with anyone who needs to hear this. Stay informed, stay prepared, and always question the status quo.